Are there other tax-free accounts in addition to Roth IRAs?
Yes, there are. And there's a myriad of ways you can receive tax-free growth or tax-free income, understanding how our tax code lays it out. So in addition to Roth IRAs, the most basic would let you know that there are Roth 401ks, right? They weren't always around. Very prevalent today, and over 88% of all 401ks in America now offer a Roth version. And this includes 403bs, et cetera. And in most recent legislation, we now actually have SEP Roth IRAs. These are usually for small employers or self-employed folks, where you can actually do those in a Roth IRA, and you can put a much larger contribution into them, which means you can get dollars into tax-free accounts. If your 401k allows it, and only about 8% do, after you've max contributed to your Roth, and you have a catch-up contribution and two catch-up contributions that now have to go into the Roth when your income gets too high. When you're over 60 years of age, you get the catch-up. Over 50 and over 60, we have two new thresholds, so you can put more money away. In addition to that, the after-tax contribution, you can make contributions into your 401k. It goes into an account that's segregated from your Roth and your traditional, and then if you follow the rules, that will roll into your Roth IRA at your retirement. Again, another way to compile tax-free assets. On top of that, if you purchase municipal bonds, if you live in a state like Nebraska or Iowa that has an income tax, you're typically going to buy municipal bonds issued from a municipality in that state, because you do not have to pay federal or state income tax on the interest you earn. Now, interest rates are not sky high. However, if you have an effective tax rate of 31% or more in Nebraska, municipal bonds may make sense for you, because the tax equivalent yield will outpace what you could get on a taxable equivalent investment. On top of that, Chip, you can do a myriad of tax-free investments through setting up proper trust work, or setting up even specifically designed cash value life insurance policies. I do all of the above. Okay.
You don't know what you don't know. This is why you check with a professional.
Well, on top of that, under the tax code today, if you had non-qualified assets, just in growth assets that didn't pay any dividends, you don't have to pay any tax on that growth until you sell said asset. You would pay what's called a capital gains tax. But under current tax law, a married couple over 65, their standard deduction, Chip, is over $46,000 with the senior deduction today. If they're over 65, you could actually go and have $112,000 of capital gains and not pay 1 penny in capital gains tax. That would be tax-free income if that was your only source of income and you wanted to sell off capital gains, have not a penny of interest from the bank, not turn on your Social Security, and you could get over $100,000 tax-free from capital gains. Again, you don't know what you don't know. So the answer is there's a myriad of ways to achieve tax-free or very low tax income in retirement, but it takes planning, and it takes typically a couple of years of work. It's not like that. Hey, if you're looking for more content like this, make sure you check out these videos, and don't forget to like, subscribe, and ring the bell so you'll be notified when we publish more content that will help you retire smart. Thanks for watching.